If you still think inflation is something that happens by accident, you are giving the system far too much credit. Inflation is not an accident when a central bank is creating money again while pretending it is doing something technical, temporary, and harmless. Inflation is not an accident when the bond market has to be quietly supported because genuine buyers are demanding a higher price than the government can afford to pay. Inflation is not an accident when the men running the system know perfectly well that they cannot cut rates honestly, cannot raise rates safely, and cannot stop printing without letting the debt machine choke on its own weight. That is where we are now. And I want to say it the way I would say it at my own dinner table, not the way a central banker says it behind a microphone. The dilution machine is running again. Most people will not understand what that means until they feel it in grocery aisles and insurance bills, in rent, in tuition, in mortgage rates, in the price of an ordinary weekend, in the strange sensation that they are earning more dollars and yet owning less life. By then, the move will be well underway, and the same people who told them everything was under control will be explaining why the situation is more complicated than anyone could have predicted. I have watched too many cycles to pretend surprise at this stage. What interests me is not the theater. What interests me is the machine, and the machine right now is simple enough that any adult willing to think clearly can understand it. The government has too much debt. Too few real buyers want to fund that debt at yields the government can comfortably live with. The central bank cannot tolerate the full market price of money because the full market price of money would break the sovereign financing structure, pressure banks, crush parts of the housing market, and expose the private credit rot that has been papered over for too long. So the central bank does what central banks always do when the arithmetic turns hostile. It changes the name. That is one of the oldest tricks in monetary history. If the public would react badly to the phrase money printing, then do not call it money printing. Call it reserve management. Call it liquidity operations. Call it balance sheet maintenance. Call it market functioning. Call it something bloodless and administrative, so that ordinary people imagine plumbing where there is actually dilution. I do not care about the label. I care about the function. If new money is being created and used to absorb government paper because the natural market for that paper is too weak at the desired price, then the dilution machine is on. A man can wear a tuxedo and still steal. A central bank can use euphemisms and still debase. That is the mother line of this entire story. You are not watching a neutral policy adjustment. You are watching the currency being managed through dilution because the debt structure has made honest financing too expensive. Once you understand that, a great many strange things begin to make sense. Why the balance sheet starts climbing again after the public was told the era of extraordinary support was behind us. Why the buying skews toward short-term government paper first. Why the conversation becomes so obsessive about wording. Why officials insist that what they are doing is not the thing it so clearly resembles. Why the public inflation measure looks calm while the lived price level feels like a different planet. Why rates cannot be cut cleanly even though large parts of the economy are already losing momentum. Why rates cannot be raised much further even though inflation pressure is still alive. Why real assets keep acting like they know something the average saver has not accepted yet. This is not mysterious once you see the machine. The first mechanism inside the dilution machine is what I call the buyer of last resort problem. A government that borrows at scale depends on one thing above all else. It depends on a deep, willing market for its debt. The public has been trained to believe that market is automatic because for decades it mostly felt automatic. Foreign reserve managers bought, domestic institutions bought, pension money bought, insurance money bought. The safe asset narrative was strong enough that the government could issue an ocean of debt and still expect enough demand to keep financing costs from becoming politically or fiscally unbearable. But a debt market is not held together by patriotic slogans. It is held together by price. If inflation is genuinely running hot, then a 3% or 4% yield is not generous. It is insulting. If deficits are huge, supply is relentless, and currency purchasing power is suspect. Buyers demand compensation. That is what bond buyers do. They are not there to admire the flag. They are there to protect capital. And here is the problem. If the market demands a much higher yield, the government's own interest bill begins to metastasize. Every additional point on trillions of refinancing is not a footnote. It is a budget event. It is a structural event. It is a future tax event. It is a credibility event. So the system faces a choice. Let yields rise to the level honest buyers require and watch the debt service bill become more dangerous. Or suppress that honesty, by sending in the buyer of last resort. That buyer is the central bank. When the central bank becomes the marginal absorber of government debt because the private and foreign sectors are not doing enough at the politically acceptable price, the process has already left the world of ordinary market functioning. It has entered the world of monetary substitution. Instead of real savings funding the state, newly created currency funds the state. That is dilution, call it whatever you like. The function does not change. The second mechanism is what I call the renamed printing trick. This is where modern monetary management becomes almost insulting in its sophistication. Officials understand that phrases matter. They know that markets and the public attach emotional weight to terms like quantitative easing. They know that words like money printing create a cleaner mental image than they want the public to hold. So they rename the same broad action according to maturity, format, and political convenience. Buy longer dated government paper and the public may recognize the old QE script. Buy short-term bills and call it reserve management. And suddenly it sounds like the janitor fixing a pipe. I have never liked this kind of verbal camouflage, but I have learned to respect it because it reveals fear. Institutions only get cute with language when they need time. Time to act before the market fully prices the implication. Time to dilute before the average citizen notices the pattern. Time to protect the sovereign structure before the public realizes that the protection itself is one more step in the debasement process. That is why the name change matters. Not because I care about semantics, because semantics are evidence. They tell you the institution knows the public would react differently if the act were described honestly. That alone should stop you. The third mechanism is what I call the inflation mask problem. The ordinary citizen is told inflation is modest, manageable, moving in the right direction, or not as bad as feared. The official measure offers a number. The number sounds technical. The commentary around the number sounds calming. Then the citizen goes outside and notices that life keeps getting more expensive in the places where actual life is lived. He begins doubting himself. That is the point where the inflation mask becomes politically useful. I want to be very careful here. I am not saying every official measure is fake in the cartoonish sense. I am saying that there is a large difference between the reported change in a selected basket under selected rules and the lived dilution of household purchasing power in an economy where the money supply is expanding. Supply structures are strained, substitution is built into the reporting logic, and new waves of liquidity are already being prepared to absorb financial stress that has not yet been publicly acknowledged in full. A man does not need a doctorate to understand that if the quantity of money keeps rising faster than the production of things he actually needs, his currency claim is being diluted. A man does not need a committee to tell him that if food, housing, transport, insurance, taxes, and financing costs all feel heavier, then the real world is speaking more honestly than the press conference. That is why I call it the inflation mask. It is not a conspiracy theory. It is the perfectly ordinary institutional habit of describing the wound in the least alarming possible language, while the patient is still conscious enough not to panic. The fourth mechanism is the yield trap. This one is the cruelest because it traps everybody at once. If long-term yields rise because buyers demand more compensation, mortgage rates rise with them. Housing affordability deteriorates. Again, refinancing becomes more painful. Commercial property stress worsens. Existing bond portfolios weaken, banks holding lower. Yield paper continue carrying losses or thinner flexibility. The government's own borrowing costs rise. The private credit complex looks shakier. Every lever in the system begins pulling on the same weak spots, so the central bank cannot simply sit back and let the long end find full honesty all at once. But if it intervenes too visibly, it validates the very fears that caused buyers to demand higher yields in the first place. That is the yield trap. Let the market clear honestly and the structure groans. Suppress the market and the currency groans. There is no painless lane left. This is where many investors still make the old mistake. They assume the Fed can eventually cut rates and rescue everyone. That was the old playbook. It worked in cleaner disinflationary environments because the institution had room to ease without appearing to abandon the currency. Today, that room is dramatically narrower. If inflation is still alive and money printing is already creeping back under softer names, then aggressive easing is not rescue in the old sense. It is confirmation that dilution has taken priority over discipline. The public still hears rescue. Gold hears surrender. That is why gold matters so much here. Gold is not waiting for the central bank to say the exact words. Gold does not need the confession. Gold responds to the structure. When a central bank is boxed in between inflation, weak growth, bond market fragility, and sovereign financing stress, gold hears the loss of policy integrity long before the average saver does. The fifth mechanism is what I call the real asset migration. Once people realize that the dilution machine is not theoretical but operational, they begin moving. Slowly at first, then with growing urgency out of nominal claims that depend entirely on the purchasing power of the currency and into assets whose value is tied to scarcity, usefulness, or pricing power. This migration takes many forms. Sometimes it is gold, sometimes it is silver, sometimes it is energy exposure, sometimes it is productive land, sometimes it is a business with genuine margin protection, sometimes it is short duration paper, used tactically while longer duration claims are avoided. Sometimes it is a portfolio quietly reweighted away from the assets that need falling yields and an honest currency to perform well. The public tends to arrive late to this migration because the early stage feels awkward. Real assets can look volatile, gold can look old-fashioned, energy can feel politically messy, hard. Asset logic rarely sounds elegant on television, but scarcity and pricing power have a way of becoming fashionable once the dilution machine has been running long enough to make the old nominal assumptions look naive. That is why I say the migration begins before the speeches admit what is happening. Now I want to take you deeper into the mechanics of why the central bank has no honest exit. The sovereign debt burden is too large to refinance at a genuinely market clearing cost without creating a new political crisis around interest expense. If rates stay high, the private sector weakens under the burden. If rates fall sharply, inflation and currency credibility suffer. If the central bank prints only modestly, the market remains stressed. If it prints aggressively, the currency is diluted more visibly and the future inflation problem grows. If it does nothing, the debt bubble and private credit pressures push toward the very depressionary forces the political system will never tolerate calmly. That is why I say the machine is not offering options anymore. It is offering trade-offs between forms of damage. The ordinary citizen thinks of this as a macro problem. He should think of it as a household problem, because the dilution machine reaches the household in three brutal ways. First, it erodes the purchasing power of idle cash and fixed income illusions. A family can watch its nominal savings balance remain stable, while its real ability to buy life deteriorates month after month. Second, it keeps longer-term financing conditions uglier than the public hoped, because a bond market under pressure does not magically produce cheap mortgages just because the public is tired. Third, it pushes capital toward real assets and away from weak nominal claims, which means the people who cling too long to the old comfort of idle money get left behind in two directions at once. Their cash buys less, and the things they should have owned become harder to buy. That is the hidden violence of dilution. It does not simply take. It also widens the gap between holders of claims on scarce assets and holders of claims on increasingly diluted currency. That is why wealth inequality often worsens in these periods. The dilution machine does not hurt everybody equally. It rewards those positioned in real or protected claims and punishes those whose balance sheet lives too heavily in cash, low-yield accounts, long-duration paper, or wages that do not reprice fast enough. Now let me make the identity flip explicit, because the emotional reward point in a story like this matters. At the beginning of a cycle like this, most middle-class savers still think of themselves as prudent because they avoid risk and hold money in familiar places. They think safety means visibility, convenience, and low volatility on a statement. That identity does not survive the dilution machine. The new identity must be different. You must stop thinking like a saver of currency and start thinking like an owner of scarce claims. That is the entire shift. A saver says, "At least my number is still there." An owner asks, "What is this number a claim on, and what is happening to that claim as the machine keeps printing?" A saver takes comfort in a balance. An owner studies purchasing power. A saver waits for the central bank to make life easy again. An owner assumes the central bank will protect the sovereign structure first and the small holder second. If at all, a saver hopes inflation will calm down soon enough to preserve the old plan. An owner restructures before hope becomes an expensive habit. That identity shift is the line between being processed by this cycle and navigating it. Now let me bring this down to an operating blueprint, because Diagnosis without action is only a refined form of panic. If I were managing a household in this environment, the first thing I would do is respect cash differently. I would keep liquidity, but I would stop pretending idle zero. Yield cash was neutral. Cash is still useful as optionality, but only if you understand that it is a wasting asset under a running dilution machine. That means reserves belong in the highest quality short. Duration instruments or accounts I can access safely and efficiently, not in checking. Account sleep. Second, I would review all long. Duration nominal exposure. The old world encouraged people to reach for duration because rates were dead and the future looked disinflationary. That world is gone. If the central bank is printing again and inflation is accelerating, I do not want to pretend long. Duration claims are a comfortable mattress. Third, I would deliberately own scarce or pricing power assets, not as a fad, not as a panic trade, as a strategic acknowledgement that if the currency is going to be managed through dilution, real assets and real businesses with the ability to pass through higher costs should occupy more mental and financial space. Fourth, I would kill toxic debt. This is not glamorous, but it matters. There is no point talking grandly about inflation hedges while paying 20% on revolving balances. A household paying predatory rates is running its own private dilution machine in reverse. Stop the leak closest to home before trying to outsmart the global system. Fifth, I would stop waiting for the Fed to restore the old world. That world depended on a cleaner debt structure, lower inflation sensitivity, and more freedom to ease without punishing the currency. Those conditions no longer describe reality. A household that understands this early can reposition calmly. A household that waits for rates to bail out every bad balance. Sheet habit will be taught a brutal lesson by time. That is the blueprint. Not because it is perfect, because it fits the machine we actually have. I also want to say something about gold, because too many people talk about it either like a religion or like an embarrassment. I do neither. Gold is not magic. It does not pay rent. It does not produce cash flow. It can be volatile. But gold has one extraordinary strength. It tells the truth about monetary constraints before institutions are ready to say the truth in plain language. That is why I listen to it. When gold rises in a world where the central bank is supposed to be restoring order, you should not immediately ask whether gold is overreacting. You should ask what the metal is hearing in the machine. Usually it is hearing a loss of room, a loss of confidence, a loss of policy credibility, a loss of purchasing power integrity. Gold does not need all those things to become official. It only needs enough evidence that the direction is set. The same is true in a more violent way for silver and certain mining exposures once the public finally joins the repricing. But the key is not the specific instrument. The key is that phase transitions in monetary cycles reward people who understand structure earlier than consensus. That is why I am speaking this way now, because by the time everyone agrees that printing resumed, that inflation never really came under control, that rates were trapped, and that real assets had been the right side of the move. The easy entry will be gone, and the people left behind will say what they always say. No one could have known that is not true. The machine is knowable, not perfectly, but knowable enough. The balance sheet is public. The debt burden is public. The bond market stress is public. The rates probabilities are public. The inflation pressure is visible in the real world whether or not the official mask looks calm. The quiet buying is there if you know where to look. The central bank language games are there if you know what they mean. The trap is visible. The printing is visible. The dilution machine is visible. So the final choice is not whether you can stop it. You cannot. The final choice is whether you will keep living as though the old nominal rules still protect ordinary savers, or whether you will finally accept that the currency itself is being managed as a sacrifice variable for the debt system. That is the harsh truth. Better inflation than depression, they will tell you, but they will not say the second sentence out loud. Better your purchasing power than their debt structure. That is what the machine is really saying. And once you hear it clearly, you stop waiting for honesty from the podium and start protecting yourself from the policy. That is the only rational response I know. The Fed is printing again. More importantly, the system is admitting through action what it cannot admit through language. The dilution machine is on, and once that machine is running, the only question left is whether you are still holding life in the form most exposed to its output, or whether you have already begun moving into the assets that survive it.